Hello viewers, a warm welcome from ARA Financial Services. We are AMFI registered mutual fund distributor since 2009, having office in Bangalore as well as in Ujire. Ujire is a small town just below the Western Ghats next to the temple city called Dharmasthala. Having a decent history of 12 to 13 years, we have been helping individuals, families, and institutions to take prudent investment decisions to efficiently grow their hard-earned money. We will be bringing a series of videos with an intention to enhance your knowledge about personal finance and investments, which will definitely create a lot of value addition for end users like you. We will also try connecting you digitally with various industry experts, fund managers, research analysts from time to time to understand their thoughts and views about capital market, economy, and so on. We believe this will definitely help you to update yourself and become a well-informed investor. Today, we will hear from Mr. Dalwai, fund manager at ICICI Prudential Mutual Fund. To tell about him, he is with ICICI since 2011, almost 12 years. By qualification, he is both chartered accountant and certified financial analyst from US. He has a strong hold on sectors like hotels, textiles, agri-chemicals, power, media, and real estate. He is the sole fund manager for ICICI Prudential Infrastructure and FMCG Fund. He is also the co-fund manager for ICICI Prudential Balance Advantage Fund as well as ICICI Prudential Multi-Asset Fund. Previously, that fund is called as ICICI Prudential Dynamic Fund. Both has a track record of more than 10 years. He is also a co-fund manager for ICICI Prudential Business Cycles Fund. We welcome you, Mr. Dalwai. Okay, without taking much time, here... Oh, thank you. So without taking much time, here is our first question for you. First and foremost, as you and me are all aware, interest rates are going up and looks like it will still go up a little further as inflation is looking north. Can you please tell us, our investors, on how it will impact the loans, because India is reasonably moving from saving to borrowing mechanism. So basically housing and auto loans, how it will impact them. This kind of inflation and interest rate going up, could it potentially cause a demand slowdown? Can you please throw some light on this?
Yeah, thank you. Thank you, Shreedhar, for having me. So firstly, I think one has to see the demand for these two products, which is home loan and auto loan, in context to how demand for housing and auto has been over the last, like a long period of time, last 5 to 10 years. See, broadly, what we have seen is that housing, if you look at the volume data, the number of houses which have been sold in the top 7, 8 cities had come down over the last, I would say, last 7 years, from 2013 till 2020. It was only in 2020 that you've seen some uptick there. And during this period of time, with the collapse in demand as well, supply had also come off. So there was a good inventory clearing mechanism which had happened in housing. It was only in the last 1.5 year that we have seen housing pick up. So I would say that in housing, we have seen a cycle of downturn over last 7 years till 20. And after 20 is just that we have seen almost 1.5 year of an uptick in housing. So I would say we are in an early stage of housing demand recovery. Even if you look at the number of houses which are sold in top 7, 8 cities, it is pretty low at around somewhere between 2 to 3 lakh. And if you look at the number of jobs which have been created, if only in IT as a sector, if you look at, so the demand looks very small in comparison to number of jobs which have been created. So our view is that the demand should see a good uptick over the next, I would say, 3 to 5 years for housing. To your point of rising rates, how does that impact demand? Frankly, I think even the cycle is strong, and this we have seen in the earlier cycle also, that housing had picked up and continued to pick up in a rising interest rate environment as well. So I don't think how it would have a major impact in terms of demand for housing, rising rates. Secondly, similarly to housing, in terms of autos also, what we have seen is that auto demand has been pretty weak over the last 1 decade. If you look at, So the number of cars which we used to sell like 10 years ago, we have sold the similar number of cars last year as well. So the demand is pretty weak. We are seeing replacement demand is weak. The number of the age of vehicle on street is pretty high. So what we believe is that over the next 2 to 3 years, we will see a very strong recovery in autos as well. So here again, similar to housing, what I feel is that the rising rates will not impact the demand much. And in both the cases, we'll see a very strong cyclical recovery, because I feel the cycle is pretty strong, and we have seen a very I would say a low cycle over the last 5 to 7 years, and it's just turned in housing, and it's expected to turn in autos. And mind you, in autos, what we are seeing over the last 1.5 years is that there are a lot of supply side issues. Demand has not been impacted much. It is the chip shortages which has impacted the demand. So as and when that eases, I think volume should pick up for auto as a segment as well.
Many thanks for this clarification. My second question will be in line with this particular question itself, wherein we will basically from the investment point of view, say inflation and interest rates both are going up now. Particularly interest rate going up is something like a cost or a burden for the economy. Definitely this should dent or it should put some pressure on growth as well as performance of the organizations or institutions. How do you see market in the near to medium term, say maybe 12 to 15 months kind of that? Along with that, how this can put pressure on the balance sheets? Can you please throw some light on that?
Sure. See, luckily and in a good way, what has happened over the last 1 to 2 years is that corporate India has delevered a lot. So if you look at the balance sheet of corporate India, it has substantially improved. So this is partly reflected in the loan growth numbers of banks as well. Loan growth has been pretty low for banks, primarily because corporate India has not been borrowing. And one other part is that inflation at times on theory also says that equities is a good hedge for inflation as an asset class, because what we invest in the listed space. Listed space is the organized space who generally have strong brands, strong products, strong services to cater to its end consumer, and they do have the ability to pass on the cost pressures to the end consumer. Having said that, it may have an impact on demand slightly, but I don't think that the ability of the corporate to pass on this high cost pressures which we're seeing because of inflation has been impaired. I think they still have the ability to do it, and the balance sheet itself has improved a lot for corporate world. So rising cost of borrowing will not impact the corporate as it would have had impacted a couple of years ago.
Okay. So you are telling us indirectly that we should not worry much as far as it's concerned.
Correct.
Okay. This third question will be more on investment process during these volatile times. At this juncture now, or at this point of time, is it easier for you to pick stocks or do a sector rotation? How exactly, what is the idea, what is the background, and what is the thought process? Can you please explain us a little more on this? Because this will help our investors to understand how exactly it.
Correct.
Yeah.
See, the current volatility which we're seeing in the market as well, it is primarily driven from top down. Rather than any bottom-up issues in corporate India or earnings growth recovery. So when there are top-down issues, I feel that there are better opportunities and there are more opportunities to generate alpha or generate return through sector rotation rather than stock selection. Stock selection, obviously, within those sectors, you have to choose the stocks which are expected to do well. That is point one. And the second point, which I generally feel is that if you look at the capitalization of the markets today, it is the large caps which are trading at reasonable value versus mid and small cap. So I would have a preference, or I would lean towards stock selection if I see mid and small cap available at a very attractive valuation, which is not the case, frankly, today. It is the large caps primarily because of the aggressive selling which we're seeing by the foreign institutional investors, like aggressive month in and month out. They have been selling in large quantities, which frankly, historically, we've not seen such a huge quantum of selling by foreign investors. and the casualty or the impact is currently seen in large caps. So I feel through a sector rotation over the next 12 months to 15 months, one can make better alpha or better returns than stock picking currently. For stock picking, I want the valuations of mid and small caps to be attractive to generate substantial return.
Thanks for your clarification. My next question will be on the present market environment. Little elaborated answer will help mass population who watch us over a period of time. So, do you consider the current volatility as a buying opportunity, or you are following a wait and watch approach? What is your take here as a fund manager? And a small brief what an investor should do also will help us here, sir.
Correct. So frankly, like if someone has surplus savings today, I feel if one can approach a lump sum approach in products like the dynamic asset allocation products. So within
Okay.
our basket, we would have the balance advantage fund, we have the multi-asset fund, we have the equity and debt fund. I feel the current volatility would safeguard an investor's capital and has an ability to generate return in these products. Just to explain a bit more on this is that these products are designed and structured to harness return through volatility,
Okay.
because historically also we've seen periods where market has not ended up generating much return, but these products end up generating decent returns but the market has to be volatile for these funds to generate returns in a no or low return environment. So lump sum, I would recommend that one should look to invest in these dynamic asset allocation schemes, because the view is that the return market environment or the ride or the expected movement of the market over the next 12 to 15 months is expected to be volatile. If someone
Okay.
wants to do or start an SIP, I would still say that one has to be linked more towards large caps today, because I still feel large cap is where there are value today versus a mid and small cap. Like I'd explained in the earlier question also that there has been, I would say, ruthless selling in large cap by the foreign investors. So the valuation is attractive, the business models are intact. Most of these companies are seeing a cyclical recovery in their earnings as well, and earnings recovery is also expected to be good. And like I mentioned earlier, that the balance sheets also of these most of these companies and even banks has improved significantly. So large cap is a segment which I feel that on a SIP fully invested
SIP.
fund basis, one can start looking to invest in this schemes and segment.
Okay, okay, that's helpful, sir. So this present question is more on businesses as well as on sectors. Which are the businesses you see which will weather this unclear environment? Because there are so many headwinds as you are explaining in the beginning, and we don't know which will this all this whatever is happening around us, which are all things are good for which sector, which is not good for these sectors. Which sectors, companies do you see posting consistent growth in earnings in the near future? Can you throw some light on sector specific
Correct.
things?
Correct. So
Yeah.
generally, when the environment is volatile, what investors and market or the people who want to invest try to look for are companies which have stable cash flows, are sustainable, predictable cash flows. There shouldn't be too much variation in predicting the earnings of these companies. The earnings have to be strong, and along with that, if these earnings are growing, the better it is. So sustainable cash flows, sustainable yield companies are preferred in this environment of volatility. So within that framework, I feel sectors like utilities, because most of them are regulated sectors. There isn't much variance from the earnings which one forecast. And within utility space, there are opportunities for companies which are growing their earnings as well. So you
Okay.
have stable, predictable cash flows which are growing, and frankly, most of them trade at a reasonable or low valuations as well. So I
Okay.
feel that segment is something where one can invest in. Telecom as well, like what we have seen in telecom as a sector is that they've gone through a very rough patch over the last 2 to 3 years, and it's only that the last 1 year that we are seeing some recovery in earnings through ARPU growth in the segment. The competitive intensity in the segment has reduced, and telecom also acts like a utility, but it's a consumer facing utility, which generally tends to trade at a higher multiple. So telecom is again a segment which has sustainable, predictable cash flows. And lastly, I would say domestic pharma companies as well. So within the defensive space of IT, FMCG, and pharma, I would say domestic pharma is a segment which can provide the predictable nature of earnings, and that segment has also not done well over the last 1 year versus uh, FMCG has also not done well, but the valuation of which pharma is available today, it is available at a very reasonable valuation for the growth and the return profile of the segment. So I would say that utilities, telecom, and domestic pharma are the sectors which can provide earnings growth and a more predictable earnings growth.
Okay, okay. Many thanks. Now, this next question will be more in general in nature. At this level now, whether India is different from the rest of the world, because we always say India is different and we have always imported issues and this, that, everything. We still seem to have few advantages in terms of demographics. Can you please explain a little more on this? Also, how it is going to impact the future of consumption as well as equities as well as investors?
Correct. So it's a great question. So in terms of
Thank you.
in terms of demographics, I think over the next 10 years, India is very well positioned to take benefit of the demographic dividend or the advantage which we have. So when you say demographics is favorable, one means that the working age population for India is expected to increase. So there was one estimate that India is expected to add 100 million people to its working age population over the next 10 years. At the same time, China, which had the benefit of growing working age population over the next 10 years, is going to see its working age population shrink. So what this does is that it makes our manufacturing more competitive in a global landscape. And to support that, government has come out with a lot of PLI schemes to incentivize, to support, and to encourage manufacturing in India. Along with this, what I feel is that what we have created is a superb service export revenue opportunity through the IT export which we have, and the scale which we have reached is fabulous and fantastic, I would say. So that again would continue because our working age population is increasing and we're able to add to the labor force out there as well. So what does this result in? This results in, like you had mentioned in your question also, is that this results in a substantial increase in consumption because salaried people would increase and they would demand for more consumer goods. So it provides an opportunity for us to invest. And generally, what happens is that the growth in these segments don't happen in a linear phase. At times, there is a non-linear growth also, which happens when you have substantial increase in a particular segment of demand. So I feel it is substantially beneficial for the discretion, especially the consumer discretionary part of demand as well over the next 10 years. So one should be positive on that space. But in equities, at times what happens is that this segment trades at a very high valuation or multiple. So as an investor, you need to find a space which is attractively priced and valued and can easily bet up, because one should not worry about the earnings growth coming in or no, because I strongly believe that over the next 10 years the earnings growth which one would expect in a consumer discretionary space would come in. But if you want to make returns on your money, you have to get the price right as well. So as and when the segment which you feel would benefit, you get at the right price, I think one should actively look to invest in that segment.
Okay, thanks. It's quite crisp and quite understanding. Thankful for that. Now, this next question is more from for investors' point of view, Mr. Dalwai. See, it is something like this. As you are aware, we are into this distribution job for last 12, 13 years. We handle more than 2,000 customers. Money comes in at different point of time. Okay, money comes in, comes in, and the same scheme, present returns or the present value of their investments in the same scheme diverge significantly, mainly because of their entry points or the type of entry. What is your suggestion for them? This question we are raising only because sometimes what happens, 3-year returns are very bad. Sometimes 5-year returns looks very bad. The way you said in the previous answer, telling that at what valuation they have entered matters a lot. But in the
Correct.
long term, over 7, 8, 9 years, lot of these things, unevenness will become even. Can you help us to help our investors how to look at their portfolio over a period of time so that they should not be worried? Because see, I was seeing a WhatsApp message, sorry, on a Twitter, I was seeing that when you are buying, when you want to buy a stock, you will just go back and see which stock has fallen drastically in the last correction. And if the stock is good, you will buy. But when you are selecting a mutual fund, what you do is go to some website and see what has done well in last 1 year, and you will go and put money there. Right? See that itself is the diverse actually.
No,
If
that
we
is
try,
very
if we
correct.
try educating them, it will put them in confused. They will get confused. Can you throw some light on this, sir?
Correct, correct. So what you mentioned was also correct. One should have a bit of counter-cyclical approach of investing. That is, you want to buy good companies or good at a lower price, because that's when you can make good returns. And one should have a similar approach in mutual fund investing as well. So where I feel is that at one level, one needs to understand that the person who is managing the money. So why I think people do that, they end up buying good performing only funds, is that you have to figure out that the person who's managing the money, he needs to have a consistent style as well. Most of the times what happens is that the fund manager at times ends up drifting from his style as well. So if someone is a growth investor, he should continue doing a growth investing style. He should not diverge from his style of investing.
Yeah.
So that is one thing which, as an investor, if we can educate ourselves, trying to figure out, is this fund manager, what is his style of investing, what is the style of stocks he likes picking up, and then form a view based on your assessment of the fund manager and the style which he's investing the fund with. That is point number one. And in terms of your question of if you have an existing position in a particular portfolio, see, there also I think one has to take a view of like you have to do a age profiling as well, like in
Yeah.
terms of what is the risk taking ability of an individual. So at a later stage of your life, I think the products which we have in terms of the dynamic asset allocation products, the structure of these products is to at times or to determine when you need to protect capital and when you need to make money. So the journey of the investor is pretty smooth out there. But in that process, you know that you are not going to make very high returns as what a small cap fund or a mid cap fund would end up delivering at a long period of time. But the predictability or the stability of the earnings or the returns is pretty high in these type of categories. So if someone is in the later part of his investing career, I think these products are pretty safe and pretty less stressful, I would say, for an investor to continue to invest in terms of a lump sum basis and continuously investing as and when they have surplus investments. And as an investor, I would encourage people to have a, like I mentioned earlier, counter cyclical approach of investing. You need to buy good funds or good stocks, whichever you do end up buying, when things are down, because the price you pay is very important for the returns which you make. If you end up buying things at a higher price, how much ever good the business is, because what we have seen over the last 3 years is that good quality stocks have not delivered returns. That was primarily because there isn't much problem with the businesses. The issue has been that the price of these businesses was pretty high 2 to 3 years ago. So if someone who had a bend of buying good companies at any price, I think the funds may not be doing well today if someone had that bend. But for that, I feel that you should try to identify what is the style of that investor and see if that the fund manager also has a criteria of buying stocks or sectors at a price. I think that is very important in trying to finding out the funds which one would want to invest in. So I would say if your funds which are currently in your portfolio, they are not doing well, I would say you assess those funds again, try to understand what has gone wrong in those funds, try to figure out, is there any change in fund manager out there? Is there a change in any style in that fund? If there is any change, then I think you may look to exit, or you may not to continue adding money to those funds, because there is some change which has happened in the fund. Your initial thesis or investment for why you invested has been broken. But if the fund manager or the style of the fund continues to remain same, I would say you should hold on to that fund, or you should continue to invest in that fund, because that style might be seeing a temporary blip, or might be going through a phase where it's not delivering, and that's the time when you need to add on to those funds.
So when you are mentioning this dynamic asset category, this balance advantage fund, and ICICI is the one mutual
Multi-asset
fund.
fund, the dynamic fund, yeah, which you spoke
Yeah,
about.
because before starting this venture, I was working for some other institution. At that time itself, we have seen this ICICI Prudential Dynamic Fund. I think you are the first guys to come with those kind of concept, and it worked well. Due to SEBI classification, I think you have changed the mandate of that scheme. If not, we are quite convinced with that. And your balance advantage fund and this asset allocation fund, I think, are the best thing that a
Correct.
lot of investors should consider if they want to be passive on their investment. We are
Correct.
quite convinced of that. Sir, my last question with you today is, with your experience over various market cycles, what is your suggestion for investors at this uncertain time? There are a lot of headwinds which we all know, because today there are a lot of readable data points. People get data from Twitter, a lot of social media, a lot of organizations, they want to promote their products, services, etc. And there are a lot of influencers today. But an investor who is quite busy in his normal work, right? Because he has his own profession, right, where he is specialized. So looks like a lot of them are confused. May not be all. And this is a jamana of DIY, die also, right? So that is also one more thing
Do
which
it
people
yourself.
are moving.
Yes.
Yeah, do it yourself. So people are moving that side. Can you please help our end users or investors on how to navigate this volatility? More than that, how to grab the information or how to avoid this noise or opinion and stay calm as an investor? This is my last question to you.
Correct.
Dalwai.
Yeah, sure.
Yeah.
Like broadly, what I've learned over a period of time is that you need to be patient in your investing. You need not be like, you should not get worried about short-term issues which come up in news or so. You need to have a long-term focus of your investments as well. And frankly, you need to bet on a fund manager, like, because you are busy in your day-to-day work. I continue to feel mutual fund is a very good avenue of you to invest, and you let the professionals manage or worry about the daily up and downs, and worry about the volatility in the market. That is a very good avenue of you to generate returns. And secondly, I think you should look for fund managers, or you should look for fund houses which have an ability to see through this volatile period, which have a very long term track record of seeing different market cycles as well. So that is also very important, because it's only after you've seen through a market cycle, you understand how to read a market cycle, and you understand what would do well in this phase of a market or a business cycle as well. So that is also very important. At times, too much or focus goes in a bottom up approach of investing, but I feel over the next 12 months, because of this volatility which has been arising because of global factors as well, I think top down basis sector rotation is a good way of, or would be a decent way of generating alpha or return. So you need to figure out funds and schemes which have a decent allocation to weightage to having a top down as a factor of looking into investing as a style, or as a factor of investing as well. So I would say, like, you need to have long-term horizon for investing. Need not worry about short-term volatility, because if you look at equity returns over a long period of time, they have been pretty good, and double digit at least, I would say, over a long period of time.
Correct.
A person who's been invested for long term would easily end up getting a double digit. I expect, because going by the historical data, is that one can expect that the double digit return in equities as well. But you need to be invested in long term. And when things look tough, I think that's when you need to invest more, because that's how you would end up generating higher return than the long term average return. And generally, if you want to do it yourself, DIY investing, if you want to end up doing, I would say, because one is a retail investor, try to stick to good quality companies, try to stick to decent balance sheets. The leverage in the company has to be low. Try to look for segments or themes which are growing. But lastly, one needs to understand that the price which you pay for these businesses has to be right. You should not overpay for a business just because it is a good business or it's a quality business. And to get the right price for these businesses, what you need to figure out, or see in market, what happens is that because of some short-term issue in a company or in the sector, like a couple of quarters issue or a year issue, the stock valuation at which the stock trades at comes down significantly, which is the market mispricing. Frankly feel that's a big mispricing in market. So as an investor, having a long-term horizon can take advantage of these mispricing. So that's when you get good businesses, because there is some short-term issue in these businesses, good quality businesses, market may not be interested, because at times institutionals want businesses which will deliver immediately. That's the nature of the market now. So retail can take advantage of the patient capital which it has and harness good return by investing in such opportunities.
So here we end. Mr. Dalwai, many thanks for your quality time and educating us and our investors. We will be definitely keeping in touch with ICICI once again as and when there are some events which will be of really help to our end users.
Yeah.
Thank you. Thanks for your time and
Thank you.
thank you.
Thank you.
Happy, have a, thank you. Have a nice weekend.
Yeah, you too. Thank you.